Americans are working harder than ever before, yet 57% of America is struggling to afford just the basics. Grocery prices are up 25% since 2019. Houses are becoming so unaffordable that President Trump is considering a national housing emergency, and for renting, the median rent has risen from $824 in 2008 to more than $1,300 a month in 2025. This is where you get into the argument. Some people say it's political, some people say it's because of Wall Street, and others say it's one big Ponzi scheme that our economy is operating. Now, I've been reading some of these articles, which is why I'm making this video, because I want to clear the air and make sure we're on the same page, because I can understand the sentiment. What a Ponzi scheme is you pay money for something, and then somebody else pays money for that same thing, and then somebody else pays money for the same thing, but the thing really doesn't have that much value. The only reason why this thing has value is because everybody else below it keeps paying for that thing. And right now, cars are expensive because people keep paying more money for cars. Houses are so expensive because other people are willing to pay so much money for these houses, and groceries are so expensive because people keep paying the higher prices for groceries. But if people stopped paying or didn't have the ability to pay for the houses, the cars, and the groceries, the prices would come tumbling down. Let me show you what I mean by starting with the housing market. Let's assume you wanted to buy this house in 2020 that cost $400,000. You put 20% down, $80,000. You could get a 3% mortgage, which would cost you $1,350 a month. If you wanted to buy that exact same house in 2025, you're not going to be able to get it for $400,000 or $500,000. It's going to cost you closer to $588,000, which means if you want to put 20% down, you're looking at closer to $120,000 in order to be able to purchase that house. And then you have to get your mortgage. You're not going to get a 3% mortgage at the time of recording this video. It's closer to 7%, which means now your monthly payment is not going to be $1,350 or $2,000 or $3,000. It's $3,100 a month for that exact same house. Because not only are you borrowing more dollars, but you're borrowing those more dollars at a more expensive rate. Not to mention the fact that because this house costs more money, your property taxes are going to be higher, and your property insurance is going to be a lot more expensive. So the real cost of ownership is now more than double in just the last 5 years. Now, part of the reason for this huge jump in housing prices is the shortage of housing in the United States. The United States is short by around 4.5 million houses. And this is where you have to understand how supply and demand work, because right now we don't have enough supply. Because we have this lack of supply, while people still want to buy houses, that means we have a lot of buyers with not enough houses available for sale. And that means the buyers are fighting against each other through bidding wars, which has been pushing home prices up. Now, that has started to shift in 2025, not just because we're starting to see a little bit more supply, but really because a lot of buyers are saying, you know what? I can't keep affording these higher prices. I can't keep affording to pay this $3,000 a month for this $588,000 a house. So we're starting to see some buyers say, maybe we shouldn't buy a house right now. Maybe we should wait and see what happens in the economy, which is why recently we've been seeing price growth cool down. And in many pockets of the United States, we've actually begun to see the prices of housing fall because people can't keep affording these more expensive houses. But it looks like there's more to the story, which really accelerated during the pandemic, which is private equity firms investing in single-family houses, because at the time we were recording this video, about 500,000 houses in the United States are owned by private equity firms, and it looks like it could potentially rise to 40% of all rental houses in the United States by 2030. That's one of the reasons why the governor of New York has been considering banning the private equity purchase of these types of rental properties in their state. Why does that matter? Because if this trend continues, which we don't know if it will or not, but if private equity continues to acquire more houses, that could reduce the supply of houses available for everybody else, which could then push up the prices of housing as well. And this is why so many people get concerned about the housing market, because if housing prices fell by 10 or 20%, I mean, in that instance, if housing prices fell by 20%, we're still well above our 2020 prices, but now you'd have millions of homeowners that are underwater. And if millions of homeowners are underwater, that could be a problem for the economy. So the reason why houses are so expensive is because people have been willing to pay so much money for these houses, but if we were to see a correction, that could create a big problem. But it's not just housing. Let's take a look at grocery prices. If you've been following the financial news at all, you've heard of the inflation when it comes to grocery prices. The reported inflation with groceries is 25% over the last 5 years, which means a $100 cart of groceries in 2020 should cost you $125 today. Now, for the average person, that doesn't make any sense because you're paying a lot more than that, but that's the reported data. Besides that, the other thing that you want to think about is shrinkflation, which is you're paying $3 for the same bag of chips, but the bag of chips is a whole lot smaller than what it was before. When you have that sort of shrinkflation, it's much harder to show those numbers in the actual inflation data. Now, the CPI numbers, the inflation data says that they account for shrinkflation, but you can imagine that it's pretty difficult to actually account for that shrinkflation in those inflation numbers, which is why many people don't understand how groceries get more expensive. And this is where you want to think a little bit practically, because if somebody was used to buying, let's say, the organic blueberries, and now because blueberries have become so expensive, you're now buying the regular blueberries, well, that doesn't necessarily get shown up because you were used to buying the organic blueberries or the organic eggs, but now because they've become so expensive, you now buy the regular blueberries and the regular eggs. You might not be seeing that same price crunch, even though you're probably paying more than what you were before, but because you've downsized, you don't see the inflation in your wallet, even though you've been shrinking what you're buying. And this goes back to what we were talking about in the beginning of this video. As long as people keep paying the higher prices, even if it's through their Visa or their Amex, that supports the higher prices while the average person keeps getting squeezed out, which means your wages, if they're not growing, are now stretching further and further just to pay for the groceries. Which then brings us back to the root of the problem for many people, which is that wages haven't kept up. Between 2020 to 2025, we have seen reported inflation at around 23%, while the reported wage growth for the median earner in America has been around 20%, which means, yes, the prices of things have gone up. Yes, wages have gone up, but wages haven't gone up fast enough on average to keep up with the reported price growth of things, while at the same time, some people are becoming wealthier. Who are those people? It is the investors. If we take a look at the stock market over the last 5 years, well, the stock market has grown by around 90%. Why do I say that? Because this inflation benefits investors. In our economic system, we have 3 types of players: the C, the I, the B, the consumer, the investor, and the businesses. And every single person is a consumer. Rich people, middle class people, poor people, because everybody's got to eat, everybody needs clothes, everybody needs a house. So everybody's a consumer. And then when you go and you spend money at the Chipotle, you go to the business and you spend money. Well, when you go to that business, who is benefiting when you spend your money? Sure, yes, the employees get a salary, but all the additional dollars of profit go into the hands of the investor, the people that own those businesses. Now, anybody can be an investor, but that's how our economic system works. You spend money at a business, the owners of the business get the profit. Now, they take on the risk as well because they can lose all their money, but they take on the risk, which means they get the profit, which means if the company gets to make more money, the investors are the ones that get rich. Well, when we have this inflation that happens, which is what we've been seeing happen, this inflation, I should call that I and F to not get confused with the investors, that means now the consumer has to spend more money at the business. Why? Because the extra guac just got a whole lot more extra. You might not be getting more guac because of shrinkflation, but you got to pay more money for that guac. So you pay more money to the business. Well, when the business get those additional dollars, who's the one that's benefiting? Well, we know that wages have gone up. So yes, some of those dollars are going to go into the business, but we know that wages haven't kept up with asset prices. So the additional dollars are going into the hands of the investor. This is why it's so important for you to become an investor, because this economic system is designed to make investors rich, period. And yes, investors take on the risk. Yes, investments crash. Yes, markets go down. Yes, recessions happen. But over the long run, the people that have built wealth through this economic system are, of course, the investors, which is why you need to understand that you have to learn how to win in this system. Unfortunately, we were never taught how to do that. Most of us were not taught how to start investing in school. Most of us were never taught why you need to invest when you're in school or how to manage your money. But it's so important because this trend is not going away. Yeah, the super high inflation that we saw in 2021 and 2022, we don't have that same rate today, but inflation hasn't gone away. Inflation is still around. Inflation cooling just means that the rate of inflation isn't as fast as it was before. But if you want to beat inflation, you have to understand how to invest your money, that way you can actually win. This is one of the reasons why I just put together a brand new investing masterclass where I walk through how you can start investing and find investment opportunities before everybody else. I will lay out the system that my firm and I use to research investment opportunities. That way you can find opportunities before the crowd. It's completely free. So if you have not seen this masterclass, I will link it for you down in the description below so you can register for it. And when you register, you're also going to get market briefs, my newsletter for investors, for free as a complimentary bonus just for joining. Now this is where I want to be 100% real and transparent with you. Some people get angry. Some people call it a Ponzi scheme. Some people call it rigged. Some people call it a scam. Call it whatever you want. The system is what it is. And the people that are financially savvy, the people that understand this, can learn how to win in the system. And my goal for you is to learn the rules, that way you can build wealth in this economic system no matter what. And in order for you to do that, you have to understand how money works. And the financially savvy understand that the way you become wealthy is by becoming an investor. Now, you can do this through the stock market, you can do this through real estate. There are many ways to invest your money, but the whole idea is you need to take the money that you don't spend, not blow it, not just spend it as a consumer, because unfortunately most of America is just a consumer. You need to take the money that you don't spend as a consumer and put it to work as an investor, and then learn how to be a better investor. That way, if you can grow your money without you working, now you're working to build wealth, and once you have the wealth, now you can spend that money however you want without worrying about the price. Because what wealthy people do is they're working to grow the value of their investments more than they are trying to grow their salary from their jobs, because they know that when you can grow your investments, this is more money that can be made without you going to work, while you're on a vacation, while you're sleeping, while you're doing whatever, because when you have the assets, now your money can continue paying you without you having to go to work. That's the concept that most of us were never taught, including me, but you can learn it. And in order for you to capitalize on it, you have to become an investor, be willing to go through the ups and downs. And if you're willing to go through the process, well, that means you can build wealth in this economic system as well. Now, if you enjoyed this video, the best thank you is to share this video with a family member, a friend, a colleague, or a fellow investor. According to Forbes, banks are quietly tightening up their lending standards, meaning it's getting harder for people and businesses to get a loan. We've seen this happen before. In the past, when banks would get stricter about their lending practices, it has been an indicator for an economic slowdown. And now with banks tightening the lending standards again in 2025, the question is what's coming next?